Guys, so now let's focus on section 3.1 where we're going to look at excess or a shortage. So we already talked about supply and demand, and then we introduced equilibrium where we were having the handshake and we were agreeing on something. Now I did mention about how basically when you're not in agreement and when you are in agreement and how you do that in your daily life is, just going through the grocery store. Because what happens is you see a price and you're like, you know what, that's too high. I don't do that one. But what you do on this one is that, you know what, I do agree at that price. So we're at equilibrium there. Well, what about that one? That one's too high. So if you don't buy it and nobody else is buying it, then I told you that the firms have to look about, well, what are we doing here? Is something bad with it or is it priced too high? And that's where the excess and the shortage comes in. Because at a price above equilibrium, right, the one that you're like, you know what, that's too expensive, I'm not going to buy it, that is where the quantity supplied is going to be more than the quantity demanded. And so there's an excess supply. Another way to say this is going to be a surplus. So what's happening here? Because businesses want to make money, right, they are going to try and put more on the shelf and they're going to try and put it at a higher price so they can get more money for it. But, right, with demand being your willingness to pay for something, and you're looking at the price and you're like, you know what, that's too high, then they're not going to sell as much. And so now we're going to have too much supply. So there's a surplus there. And what this looks like on a graph is this. So we have the equilibrium price where we are agreeing at $1.40. You see where we're having the intersection there, that's at $1.40. But let's say the price were $1.80. So you're walking through the grocery store and then you see the price tag and it says $1.80. And you're like, you know what? I don't agree with that. I'm not going to buy it. And so you and maybe somebody buys it, but a lot of people don't. So maybe 500 people are buying this. And if you're wondering how did I come up with 500, looking at $1.80, okay, and I go straight across here, what's that first curve I hit? And if you're not wondering what it is, look at this curve here. It's the demand curve. Remember, the demand is downward sloping. So this is the demand curve. And so this is the quantity demanded. 500 is the quantity demanded. And now, if we kept going over here at $1.80, we would end up over here at this point. And this is the supply. So this number right here, which is about 680, that's going to be the quantity supplied. So basically what's happening here, HEB has 680 units or million gallons of whatever, let's just say. For example, let's make it simple. You're going through the grocery store and you see $1.80, and then in total, HEB is trying to sell 680, but only 500 people are agreeing to pay $1.80. So what's happening there? The HEB is supplying 680, but we're only having 500 people buy it. So now we're having this extra bit of whatever it might be. We're having this extra supply that's not doing anything. So what would happen in the future? So HEB takes this information in, right? They take in that positive information. What happened? And then they're looking like, what should we do? And in this situation, they look at it and they're like, you know what? What if we lowered our price? So sometimes when you see a discount on something, it's because maybe they're trying to move it off of their shelf. Because if they go lower on price, what happens to quantity demand? Quantity demand is going to go up, and then they're going to buy more, and that'll be closer to the equilibrium price. So that's what would happen when we have a surplus. So when you have a surplus, what's going to happen is you're going to have a downward pressure on price. So right here, anything above equilibrium is going to have a downward pressure. And you're wondering, why is it a downward pressure? Because at the current price of $1.80, you're not selling enough, and then all of a sudden what happens next? Like, how can we better ourselves? Well, we could lower price and then we can be at equilibrium. What had to happen to price? Price had to go down. So that is where the downward pressure comes in. The market will always work towards equilibrium. Markets will always go back to equilibrium, because what are the firms going to do with an extra supply? What are they going to do? They have to sell it, right, or just throw it away. And that's not what a business is going to do. They are going to lower the price as close to equilibrium as possible so they can make as much money as possible. So they have to go to the equilibrium price. The market will always go there. Now, what about a situation where we have a situation where people are buying a lot of something? Remember earlier when I was mentioning about the demand for gas because of a hurricane? So a lot of people were buying gas at one time, and then all of a sudden we didn't have enough gas coming in, so we had to bring it in from other states. So that was a situation where we had excess demand. And what was happening there? Well, at a price below equilibrium, you're going to have quantity demanded greater than the quantity supplied. So there is excess demand. And this is going to create what we call a shortage. A great example of a shortage is going to be toilet paper. Right? Back with COVID, there was a big situation where we had a shortage of toilet paper because everybody was buying so much of it, and the businesses couldn't keep up. So that was creating a shortage. In a situation where we have a shortage, how can we fix that? Well, let's go back to the issue here. The issue is that you're having excess demand. So businesses can't keep up, and the only way you could really slow people down is by doing what? How can you stop people from buying something? You could raise the price. Because if you raise the price, what happens to the quantity demand? It has to go down. The law of demand says higher prices, lower quantity. And so when there's a situation with excess demand and you're creating a shortage, what is going to happen to price? Price is going to go up. And so that's what's happening here. So in the situation where we have toilet paper and all of a sudden people start buying so much of it, we're creating a situation where there's an excess demand. And when we're creating this situation where excess demand, price should be higher. So there is going to be an upward pressure on price. So here at $1.20, this number right here, what I just circled in green, let's call it $5.50, that is the quantity supplied. So let's call it QS. That's the quantity supplied. If you're wondering, why is this the supply curve? All I did was I go over, and the first line I hit, I'm going to figure out what that is. And sure enough, it's the supply curve. So that is the quantity supplied. I keep going over, and then all of a sudden I start to go over into the demand area. And if I go straight down here, that's going to be 700. So we're having a situation where 700 is what is demanded. And then we have a situation at the same time where 550 is all that you have. So what is the shortage, right? If the quantity supplied is 550, but your people are demanding 700, how much is the shortage? 700 minus 550. So there's going to be a shortage of 150. That is the shortage there. So how do we fix the situation? We raise price. Where does the market always go to? Equilibrium. And that's exactly what happened here. So whether we have a surplus or a shortage, the market will eventually work back to equilibrium. And you're probably wondering, well, why do we raise price in order to stop people from buying something? Well, let's think about it this way. You're having more people wanting to buy something, right? So it's just like, okay, what do businesses want to do? They want to make money. How can you get more people to supply something? You incentivize them, right? You make sure that, hey, by making more stuff, you can sell it for higher, you can make more money, so please make more stuff. And so it's kind of twofold, right? It's like you kind of want to slow people down so you can catch back up, so you can supply them. And so that's what's really going on here when we have a shortage on something. So if you read in the news that there's a surplus of something, that could mean that prices are probably going to come down. There could be a discount on something coming. If you see on the news that there's a shortage, then you could expect there to be higher prices on it. Gasoline is a fantastic example of having a shortage, because as soon as something happens where we have less gas, you're probably expecting higher prices. And there are other reasons for that, but that's usually what happens when there's a shortage. So that is it for section 3.1. We're now going to be moving into section 3.2, where we are going to be talking about the things that are going to be changing supply and demand, the things that are going to be changing your willingness to pay for something or your willingness to sell something. So it's going to be interesting. I'll see you there.